Very good evening, everyone, and hope everyone is doing very well from work from home. Thank you for joining this evening's webinar on the topical series on portfolio goals. Vibin growth or income. My name is Ernest. I'm your moderator for this evening. Tonight, we have our two speakers with us, Tim, who's our content composer, also known as our head of content, with over 10 years of experience in the financial industry, including stints at Schroders and the most recent at Motley Fool. Tim believes that successful long-term investing is within everyone's reach. Boon, who's our chief investment strategist, who is based in Melbourne currently. With his over 40 years of experience, he has worked in the financial media and banking and finance industry. He has also two passions that's very interesting in markets as well as martial arts. So tonight, we will hear from these two gentlemen to share with us more on portfolio goals. So a brief introduction of ProsperUs again. For those usual attendees, this is nothing foreign to you. For first-time joiners, ProsperUs is a digital investment service launched by CGS-CIMB in March 2021 for digitally savvy individuals. It is targeted at the millennial segmentation and is also powered by a team of young millennials. We are also the #1 stockbroker in the Singapore market. We adopt also a multifaceted approach on our service models to answer to all our clients as well as our prospects' queries via social media or even via traditional emails. As part of our education engagement, we are here tonight with our investment education series that covers a range of asset classes and also their do's and don'ts from our investment specialists. So look up more for the coming months. Last but not least, with competitive rates, free trades, and also we also reward our members with experiences that they can enjoy. For those who are new to investing and do not have an account yet with us, you can always sign up from a demo account by scanning the QR code above. Good news to all our members, our mobile apps are finally out in the respective Google Play Store and Apple App Store. So you can just Google or you just type in ProsperUs and you can download the application. For those newcomers, you can also register for an account via the mobile app. Last but not least, do follow our key social media handles on both Instagram and Telegram to receive up-to-date content from Team ProsperUs. So without further ado, I'll hand over the time to Tim to start the session on portfolio goals this evening.
Hi, everyone. I'll share my screen. Can start presentation here. Let me just talk through a bit about first, whether you actually are an investor that is more suited towards like growth stocks, or whether you're an investor that's more suited to income stocks, or whether you think you have a mix, or you kind of want a mix. I think there's no right or wrong. So I think this kind of quick 10-minute presentation to kind of try and show and give you an example of where you stand or what kind of risk tolerance maybe you have towards investing. So let's get through the boring stuff. Like the compliance disclaimer here. So this is my all my own personal opinion. This should be not construed as personalized financial advice. Yada yada yada. Okay, so what is growth investing? So first off, growth investing, I think everyone kind of puts it into this bucket of like super high risk. There's loads of revenue growth. There's loads of volatility in the share price. And I guess if you're thinking about growth nowadays with crypto, that's probably what you're going to get. Thinking about Dogecoin, thinking about Elon Musk on Twitter, that's not growth at all. Okay, so this is a completely different concept. So cryptocurrencies, all that meme stock type of stuff, that's more in the speculation type of bucket and not really the investing type of bucket. So speculation and trading, I think, is a totally different game to actually investing. So I think investing is a different way of growing your wealth, and I think it's obviously a more sustainable way of growing your wealth. So I think we should kind of understand what growth really actually represents. So growth stocks they tend to have quite a few common sort of characteristics to them. So first off, they do actually have fast revenue growth. You're talking at upwards of at least 20, 30%. Although obviously last year with the pandemic, you saw some really crazy growth numbers with some of the companies posting, 100, 200. I mean, in Zoom's case, I think it was sort of like 380 or 400 something percent year-on-year growth. So when you look at revenue growth, it's typically on a year-on-year basis. So it's, say, the first quarter of this year, what is the rate compared to the last quarter, the previous quarter of last year, the same quarter in 2020. Second, they have a huge total addressable market. So how they measure that is, obviously, I think that's quite a subjective term in terms of, how much revenue they think there is in a certain market. So for example, in e-commerce or in mobility, I mean, Uber likes to throw out that, mobility is a $7 trillion market. That's really great. That's fanciful. But obviously, I think you have to take that with a pinch of salt, understand, whereabouts on the scale it really stands. Obviously, with Tesla and EVs, that's a massive market. So I think you're looking at these types of growth stocks that have just started out in terms of their business. And they have a massive, massive runway for growth, for the growth of their business. So if you think about Amazon back in 2000, that was obviously a massive runway for growth. And even now today, Amazon is still actually considered a growth stock. I'd say, third, like they tend to be relatively smaller market capitalizations in terms of the market cap. So if you're thinking of your mega cap companies like your Microsofts or your Apples, they're like, over $1 trillion, and Amazon's over $1 trillion. And even sort of mega caps in the sort of 200 to 300 billion range are probably a bit more mature. So if you're looking at younger companies, I mean, smaller market caps, like small caps, tend to be 1 to 3 billion. But I'd say, anything up to 10 billion, you're looking at a company that has a lot of potential to grow that market capitalization. And then lastly, obviously there's a lot of talk with interest rates nowadays and, things moving at the Fed funds rate moving up and growth stocks taking a hit, because that's obviously discounted, the future cash flows are discounted to the present. So if interest rates do go up, then obviously, growth stocks technically should take a hit. But you haven't really seen that recently in recent moves. You saw a bit of a sell-off yesterday based on the Fed, but then last Friday there was inflation, which actually turned out to be higher than expected, and surprisingly, the market went up. So we can't really think about the macro too much when we look at growth, but do know that obviously a lot of these profits in growth stocks are in the future. They're not in the present. So that's something really important to remember as well. Okay, so why invest in growth stocks? Well, I think you can see on the right-hand side chart there with Amazon. Obviously, that's a classic example of a growth stock all time, how much it's kind of gone up, 189,000%. Obviously, you would have taken, I think, around a 90% hit if you had bought in 2000 and then been at the top of the bubble. So you would have had to have held that and been patient all the way up to, I think, probably, at least 10, 12 years, you would have started to make money again. But if you were patient with Amazon and you did kind of, hold out, then obviously you would have made a lot of money. So I think first off, we kind of need to understand the characteristics of why it's positive to own these disruptors. Usually growth stocks are the ones that are going to, dominate the S&P 500, say in 10 years. So say 10 years ago, you didn't see Amazon, you didn't see Apple, you didn't see sort of Facebook and Google in the top 10 companies by market cap in the US. But now all these obviously dominate the S&P 500 benchmark. So they disrupted, businesses that had been sort of cruising along. So retail, for example, and Amazon, and then Amazon obviously went into, cloud computing, and then went into e-readers, and then kind of, went into Amazon Prime. So you kind of see all the big tech companies kind of figure out a new market and then go into that market. So what they do say initially in terms of their market, total addressable market, that is always open to growing. So I think that's the beauty of growth stocks. You're owning disruptors and you have to find the right ones, obviously. Share price appreciation is obvious. That's the key one. So if you're looking at, long-term returns, that's where you're going to find it in growth stocks. If you're looking at sort of more stable dividend stocks, that's going to be a bit more, run of the mill. They don't tend to be disruptors, but they can obviously provide that stability. And I think most importantly for growth stocks, you have to have that long-term time horizon. You have to be willing to let the company prove your thesis right. And you have to be, obviously willing to stomach some of that volatility, which is never easy if you think about, some of the stock price movements that we've seen in some of these growth stocks. So you do have to handle volatility. So that's an important one. I think mainly because there are, obviously examples of companies that have done, extraordinarily well, and then maybe they've hit a speed bump, and then they've come down sort of 60, 70% over, a few months or maybe over a year. So for example, in 2011, Netflix, which we all, live with nowadays and watch, they actually were a DVD mail to order and streaming company, right? When they started out in about 2003, 2004. And in 2011, they decided, okay, we're gonna sell off and hive off our DVD, mail to order business because we don't see a future in that. And we're going to hike the prices for our streaming business. And so investors hated that and the public hated that. And so the share price crashed about 80% in, I think about sort of 3 or 4 months. But if you'd held on and if you'd bought at that sort of crash in at the 80% bottom, or if you just held on to your stock, you would have seen a 5,300% return over the past sort of 9, 10 years to where it is today, right? So I think it's more about having belief in the business model, having belief in the management, really thinking about where the growth opportunity is and where you see the world going. Because if the world is going in a certain direction, and a company sees their future in that direction, then obviously I think the share price will follow. I think that's a natural tendency. Okay, so yeah, growth here in blue chip stocks. I think blue chip tends to be safe, right? You think of it as big, as stable, not much volatility. And I think this sort of FANG stocks now have become blue chip stocks in that they are just humongous. They generate so much cash flow. So Apple, for example, the free cash flow over the past 12 months is about $90 billion US. So you're looking at a company generating that much cash on the top line in terms of sales, and then that dropping down into free cash flow. It's quite amazing. So I think if you do think you do want to go into growth, it would be, if you want to dip your toes in, those types of companies that are still growing, Microsoft and Amazon and Apple are still growing at 20, 30, 40%, which is insane for companies their size. And so there is growth to be found in bigger stocks as well. So as I said previously, it does tend to be in small stocks, but that doesn't mean that you can't have, sturdy, reliable blue chip stocks that are also growth stocks. They're disruptive, as I said, right? And quality, what's the quality of the growth stocks? I think that's the key that you have to look at is, the financials and the fundamentals. They can have like 200-300% revenue growth, but they, could be burning cash, sort of like an Uber or a Lyft, right? That they've got great revenue growth, but they're just burning lots and lots of money to take market share, and it's not really getting them anywhere. And then finally, pricing power, right? I think large companies tend to have that. If they are a specialized niche player, they may have that, but pricing power is important because that, as I'll come back to later, that comes into the inflation story as well. Okay, so what about dividend investing? So I think a lot of people in Singapore love dividends, and in Hong Kong, where I'm from, they also love dividends because it's tax-free. So, anything where we don't have to give our money to the inland revenue is always good fun, I think. And who doesn't like passive income, right? You've got to love passive income. So if you've been investing over a period of time and you compound those dividends, that's going to give you more dividends. And if you reinvest those dividends, that can produce more cash flow for you later as well. Okay, so what are the features of dividend stocks? As I said, strong cash flows. They have a lot of cash that they can give out as dividends. So, for example, even an Apple actually pays a dividend as well because it has so much free cash flow that they're able to pay a dividend and keep raising it on a regular basis. Second, Okay, so reasonable payout ratios. They don't pay lots of their profits in dividends. They only pay perhaps a percentage of around, up to sort of 50 or 60%. And then the rest of their profit they can reinvest, or they can keep as cash. They tend to be relatively more mature companies. They're a bit older. They have a lot of banks are obviously well-known dividend payers. A lot of oil companies are well-known dividend payers. And you also have companies, in the consumer discretionary space and healthcare that also pay dividends, and obviously utilities because they're quite stable. And they also tend to have low debt, these companies, and the earnings growth tends to be quite steady. So you don't tend to have explosive earnings growth or explosive revenue growth, of upwards like 20, 30, 40%. It would probably be sort of maybe up to 10% or in the mid-teens. Okay, so this is one point I really wanted to make clear to everybody. When we think about dividends, they do actually contribute strongly to the overall returns of the market. So if you look at the S&P 500 here, this is just looking at it by decade. The blue bars represent how much the dividends actually contributed to the total return during the average total return during that period, or the average annual total return rather, during that period. So the gray bars are basically the price, right? That's the price that it's moved up by. And then the blue bar is actually the dividend. So if you think about 1930 to 2020, so you're looking at the average annual return there, and the average for all decades. So 41% of the average decade return actually came from dividends. So that kind of shows you the importance of the dividend in overall returns, especially for the market as a whole. So when you're looking at, say, the S&P 500, or you're looking at maybe the Straits Times Index or the Hang Seng Index, there tends to be a big component of that comes from dividends being reinvested. Okay, so I wrote a really good, what I like to think is a really good article on, not fixating on the yield for dividends. So, we've got a QR code here, go check it out. It's on our Prosperous marketing site. So basically what it is, what can Singapore dividend investors learn from HPH Trust, which is Hutchison Port Holdings Trust. So, it's been a great stock to hold if you don't like money, or if you like to burn your cash. It was trading at about $1, I think $1 about sort of 8 or 9 years ago, and it's now trading about 23 cents. So you can kind of see the destruction of capital there. And, it was trading for a long time on dividend yields of 9, 10, 11%. And that's something that's really, really dangerous for us as investors. We shouldn't focus on the yield. We should actually look at the dividend, whether it's sustainable. And obviously in HPH's Trust's case, it was not sustainable, and they kept cutting it year after year for quite a few years. And then eventually, people lost faith in the company, and it dropped out of the Straits Times Index, but it actually used to be in the Straits Times Index. So it's a good lesson to understand, not to focus on yield. And I won't go and drone on about that because you can read the article. And so the lesson, I think, from this for dividends is just look at the total returns of dividends, because the total return is the price plus your dividend on top, right? So there's no point investing in, say, HSBC 10 years ago, and then looking at your capital deplete by 50%, as you can see, 20 years ago. It's about 50% down from where it was 20 years ago. But your total return is positive, and that's great. That's slightly positive. So your dividend has given you what, sort of around 85%, just above 80%. That's great. But then you look at a company like Starbucks, which had a really sort of small dividend and only started paying a dividend, I think, about 10 or 11 years ago. But since then, it's grown its dividend about 25%, on average per annum. And you look at it, price change from 20 years, over 20 years, and look at the total return. So that dividend there has given you about sort of close to 500%, right, in 20 years. So I think the problem, we tend to approach dividends as in, like, let's focus on the yield and how good the yield is, even though your capital, or what you're putting into the stock, is getting destroyed, right? So I think it's important to look at the total return. So the total return of HSBC was slightly positive. I don't think it would have beaten cash, to be honest. It probably would have been better holding cash over 20 years. But you know, the Hang Seng Index easily outperformed. I think the total return of the Hang Seng, which is the benchmark in Hong Kong, it returned about 300% over those 20 years. And obviously HSBC is about 1/10 of that. But you know, a lot of people were saying, oh, HSBC pays a dividend, you have a 5-6%, it's a great bank. And you know, obviously I've seen a lot of people lose money being in Hong Kong, and I've seen a lot of you know, a lot of older people being really upset about that company and that stock. And I think it's, you know, it was the classic, oh, we're just going to trust it because it pays a good dividend and it's got a high yield. And I think that's what we like to call it, what, you know, people tend to call a dividend trap. And so that's something that we should try and avoid as much as we can when we invest for dividends, is don't focus on that yield, focus on the dividend per share, and focus on how often does that grow, and does it grow every year, and does it grow consistently, right? That's the key. Does it grow over 10 years? Does it grow over 15 years? I don't want it to grow for 2 or 3 years. I want it to grow for 10 years. I want to grow for 15 years. And that will continue to compound for you. And that's the beauty of dividends. You know, you've got to look for the really, really strong ones that will give you those compounded returns. Well, that's me finished, Ernest. I'll just kind of plug our upcoming sessions for future webinars. We're doing one on understanding businesses. So I'm going to dive in deeper about, you know, what we should look for when we kind of want to approach businesses, give you some of the key metrics, maybe for more the growth oriented stocks out there. And then why the sectors that, you know, business operate in also matter so much, because we live in a world where, you know, structural stories are really key. And if you're in the wrong sector, it doesn't matter how good your business is, the share price won't reflect it, because you're in a bad business, a bad sector, and it will suffer. So so that's something that's really important to remember. And then, you know, we're doing one with our own sort of in-house fund specialist, Jake Chow. So, you know, if you want to understand how to best pick mutual funds and understand if mutual funds are right for you and how to go about picking them, because I think there's a lot of minefields in that space, then, you know, join in and kind of understand what to look for in winning funds when you do pick them.
Yep. Yeah. Thanks, Tim. Okay, so definitely I'm one of those people who definitely fall into the dividend trap over the last couple of years. So to be honest, we will go for one poll this evening to see everyone's choices. Do you prefer growth or income investing? So we'll let it run for about 15 to 20 seconds, and then we can see what the respondents are showing. So what's your take, Tim?
I think it would probably be a mixture, I would say. I'm a bit younger, so I tend towards growth, but I think it depends on also your age and where you are in your investing journey. Obviously, if you're a bit older, you don't want so much volatility, but if you're younger, you have the time horizon to take more risk. But if you're 5-10 years away from retiring, you don't want that risk in your investment portfolio. Yep. But I think the best mix is always the best way to go is always a mix, I think.
Yeah, definitely. But sometimes it's really very hard to calculate that, you know, whether your dividends in the long term does break even to cover the capital shortages in terms of, you know, like I would think like Singtel, all this type of stocks used to be very high in dividend. So then recent crashes, you know, you might not be able to cover your capital loss with the potential dividend cuts.
Exactly. Yeah. I mean, the HSBC is a classic example.
Yeah. You know? Right. Okay, let's see. Okay, I think almost 60%. Let's have a look at. Okay, I will share the results. So, okay, wow, about 60% of the respondents here actually mentioned that they have a mixture of growth and income. Everyone is also looking at growth, so none is really on income. So I think it's interesting to see this data points, and I think the next points we will hand it over to Sebun to give the continuation of the second part of our webinar. Sebun, over to you, please.
Hi, thank you very much, Ernest. Thanks, Tim, for that exposition of growth versus value stocks. But look, value stocks or growth stocks, whichever you choose, the most important thing is you get good stocks. There are good stocks and there are bad stocks. And there are good value stocks and there are bad value stocks. There are good growth stocks and there are bad growth stocks. So how do you judge whether a stock is good or not? Well, that's a long story, which will require weeks and even months of learning. We don't have time for that here. So let me give you a few shortcuts. Allow me to first summarize the three big things to consider. The first thing is, does the company have a good business? Does it have a sound management? The second thing is, does it have financial stability? And the third thing is, is it offering decent relative value? So, okay, number one, good business, sound management. It sounds simple enough, but that can be so difficult to determine for an outsider. And it's so vulnerable to very subjective judgment. So an objective yardstick that might reflect both the quality of the business and the quality of the management is something called economic value added, or EVA. Now, it's a complicated concept, but if the return on invested capital, or ROIC, is greater than the weighted average cost of capital, WACC, the company is said to be creating value. If it's less than the WACC, if the ROIC is lower than the WACC, it's said to be destroying value. Now I can see you saying, look, it's all very complicated, and it is. Calculating EVA, economic value added, requires a lot of complex numbers, formulas. So allow me to suggest a simple and rough gauge or proxy. Simply look at the company's return on its equity, ROE. It's another acronym, but you can get that quite easily from stockbrokers' reports or even the company's annual reports. Then you compare that against the cost of equity. Now that again sounds very complicated. I'll give you a shortcut. By my rough calculation, the cost of equity for the Singapore market is around 7% at the moment. So shortcut, rough proxy. You want your choice of stocks to have an ROE of more than 7%. The greater over 7%, the better. You don't want it too much below 7%. That's the first thing. The second thing, as I said, financial stability. Now, even if you have the world's greatest business, if you have too much debt, your business can fail. So how do you know if a company has too much debt? So again, there's a long story and there's a short story. Let me give you the short one. Very rough guides here. A debt to equity ratio of around 1.5 times is fairly normal, right? Now, how do you get the debt to equity ratio? Most stockbrokers' reports on companies will have that. Indeed, a lot of companies, the annual reports will also have that. So 1.5 times for the Singapore stock market is fairly normal. Lower is better. But if it's over 2 times, you really want to ask some questions. You want to find out why its debt is so high relative to equity. In some industries, that may be common. For example, property developers. So don't be indiscriminate. Be discriminate. Just ask the right question. So if the debt to equity ratio is high, say 2-3 times, compare that with other companies in the sector. That'll give you an indication of whether that's normal within that particular industry. So another measure of financial stability is the current ratio. It's the ratio of current assets to current liabilities. Ideally, it should be above 2. You want it to be above 2 because it's the ability of the company to pay its debts when they come due. You don't want to have a great business, but you just cannot pay the debts when they come due, and then you become bankrupt. So if it's lower than 2, if the current ratio is lower than 2, ask questions. And again, compare that against industry peers. So that was number 2. Finally, number 3, valuation. Now, the most commonly used valuation yardsticks are the forward or the next 12 months, PE ratio, the price to earnings ratio, and the PB ratio, which is the price to book ratio. Now, these are all relative valuation tools. Relative because they vary according to the industry and the stage of the markets. They are not fixed. At some stages of the market cycle, they can be higher. In some industries, they can be higher. In some other industries, they can be lower. So look at all these things, the PE and the PB ratio, look at them always relative to the industry peers, to the industry average. So that'll give you an idea of whether you're paying too much for a company relative to what else you can buy within the same sector, within the same industry. Now, look, there's so much more that I can say about these things. Maybe if you are interested, reach out to us. That may be a topic for another webinar if there is interest. But I think for now, I'll hand you back to Ernest and we can take your questions. Thank you.
Thank you, Saibun. Okay, so without further ado, I think, Tim, we will start the Q&A session. So we'll wait for the Tim to actually show what are the questions for this evening. Okay. So yeah, the first question that we have, does the PE ratio help at all to identify growth of stock?
Great question. So the PE ratio itself tells you nothing about the growth of a stock, right? So what you need to do then, so this is what I meant by there's so much more we can talk about this, and I'm glad they asked this, because one way you reconcile valuation and growth is something called the PEG, the PE to growth ratio, PE to growth ratio. It's known in the industry as the PEG ratio. A more sophisticated one is called the Lynch ratio, L-Y-N-C-H. It's named after a very famous fund manager called Peter Lynch, I think it is. Yeah. So it's called the Lynch ratio, which looks at the CAGR, which is the compound annual growth rate for the next 3 years earnings growth, right? They get the CAGR for the next 3 years and they put the PE and they divide it by the CAGR for the next 3 years, right? So the rough rule of thumb is that the PE should generally be better to be less than 1 compared to the compound annual growth rate. So in other words, if you had a compound annual growth rate over the next 3 years, per year, of course, or say 15%, right? You generally want the PE to be 15 times or lower, right? The lower, the better. The higher, no good. So that goes to the concept of growth at a reasonable price. There's a term for it. It's called GARP, G-A-R-P, growth at a reasonable price. So that, in a way, sort of reconciles what Tim was talking about, value versus growth. So as you can see, I've got gray hairs. I'm an old guy. In the old days, they didn't talk about value versus growth. So these are called investing styles. And these are very, what's the word for it? Trend driven, or not sentiment. It's trend. It's trend. It's the mood of the market. So, but a long time ago, there wasn't such a thing as growth versus value. So we try to combine the two and look at growth at a reasonable price. So look at the PE relative to growth. Below 1, okay. Above 1, you know, try to keep it
Okay.
too much above 1, okay?
Okay, thanks. Thanks, Vibin. So any other comments from Tim on this?
I think for growth stocks, I mean, yeah, I agree with Vibin. It's like not really a very useful metric. And then also, I guess nowadays, a lot of growth stocks, they don't make any profits. They're like a lot of them are actually loss making. Doesn't mean they're a terrible business. I mean, there are obviously a lot of terrible stocks that are making losses, growth stocks, but just because they're making a loss doesn't mean it's a bad business. It just means they're reinvesting a lot of money into the business. So the P ratio is meaningless because they're not actually earning any profits. So being, obviously profitless and loss making, your P is going to be negative, or and for the longest time, something like an Amazon was producing, negative P, and then it went into profit, and then it was still a ridiculous PE, right? So I think for growth stocks, what a lot of people now use, the metric is price to sales. So you're looking at the sales, and then a percentage of that, basically, in terms of price, the price as a percentage of the top line of the revenue. And then you basically are looking at a multiple, and if it is, I guess above a certain multiple that it's traded beyond for, so say the market cap of a company is 10 billion, and they're trading at a price to sales of 10, that would kind of say the market cap is 100 billion, and they're trading at a price to sales of 10. That means their sales are 10 billion, right? So the market cap is 10 times what their annual sales is. So it would depend on the historical trend. There are some crazy price to sales ratios out there. I mean, there's something, like a Snowflake that traded at 70 or 80 forward sales, something crazy. And then even Zoom is trading at sort of 40 or 50. And then, a lot of the SaaS stocks now are trading in the 20 to 30. So, 1 to 2 is considered normal back in the day, but I think things have changed. Obviously, Sabin, you probably think it's a bit mental, like some of these price to sales ratios that you see nowadays. But, I think this is kind of what people are starting to use as a yardstick rather than PE, because PE is not.
I'm very respectful of alternative views, especially the views of younger people.
Yeah.
But the gray hairs tell me that I cannot take away their sales revenue. I can only take away what has been earned as net profit.
That's right. Yeah. Okay. Hope that answered that guy's question. And let's go for the next one. What's the second question on the block? What's the outlook of US equity markets in the next 3 months? Wow.
Is that for me?
I think you can start off with Sabun first.
Sure. Look, I think the next 3 months is going to be a little bit bumpy, but it's not the end. It's not the end of the bull market, to put it that way. As I said, it'll be a little bit bumpy because, as you just saw last night, the Federal Reserve's opinion of rate hikes has shifted slightly, not hugely, shifted slightly. We at CGS-CIMB, and I wrote this in a piece on inflation, on a few pieces on inflation and interest rates over the months, and I've always said, look, late 2022 or early 2023, you will get your first rate hike. So now the markets now suddenly go, okay. So now the Fed is saying we'll get 2 rate hikes sometime in 2023. So it's no surprise to us, right? So, but the market will have to digest this. So it will be a bit bumpy. So you're going to see the market correct a bit. But it doesn't necessarily mean the end, because the Federal Reserve, I believe, will be true to its word. It will hold its rates at 0, effectively 0 to 0.25, and it will continue to buy down US Treasury yields. and it leaves you with very few options. Being in bonds is even more dangerous than to be in stocks, right? So your choice is not bonds and stocks. Your choice is cash or stocks, right? So cash is earning you this now, right? As we all know, right? And bonds is just downright dangerous. So you're still going to be in stocks. So my guess is that stock prices will go higher by year end, but next few months will probably be a little bit rough, but eventually they will move higher.
Thanks, Abun. Tim, how about you? Bullish or bearish?
Yeah, I mean, I agree with Sabun that, you know, like I think the market was probably caught off a bit, you know, off guard yesterday with the sort of a bit more hawkish tone, but I don't think it's necessarily a bad thing. It's that actually, because they want to raise sooner than expected, that just shows that the economy is doing better than expected, and obviously inflation is running a bit ahead of, you know, of what they expect, but it also shows that the economy is bouncing back quickly, and you know, vaccinations are accelerating, so they're actually coming out of the out of that sort of dip a lot faster than they thought they would, which is good, which is great. And so businesses, you know, I think this year the bounce in sort of earnings is going to be strong. I think that's obviously being priced in, and people know that. So I think it's more about what's it going to be like, you know, next year, early 2022. Is it going to be you know, are they going to be able to continue growing like earnings companies? And just because rates are rising, you know, people always freak out about it, and the market always freaks out about it. But rates rising, you know, it happened in what, 2017, like before, you know, they were starting to raise rates earlier, and then obviously the pandemic hit and they had to cut right down to zero. But, you know, the market survived that. And so I don't think it's anything to be too worried about. But yeah, I agree. There's probably going to be some volatility in the next few months as the market sort of goes through it and works through it. But, you know, I think life will go on, and I think the market will be fine.
It's good to hear that markets are being bullish. And I have a personal question on that. What's the dependencies on the US market? Because they are the largest markets in the world, right? So you can see that Singapore closed today on a low, lower than expected. And like I have no idea why Hong Kong actually did pretty well. So is there correlations in the market's performance as an indication? Like traditionally, people will say that we take indication from the US markets. Do you think that the trend is still currently in this format? Yep, Sabun.
Okay. The biggest investors in the world are fund managers, the mutual fund managers, the pension fund managers. They run massive portfolios on a grid. Yeah, so they run it on a grid that links various risk profiles, right? So when the US market, which is the largest in terms of market cap, when the US market sells off, right? So the whole grid moves, the entire grid moves, because they're all linked, right? So when you are risk off in the US, you would also be risk off elsewhere in the world, right? So, and you would typically sell those markets that are higher volatility, that have higher standard deviations, which tend to be the emerging markets. So you tend to also sell them as well, and probably sell more of them as well. So that generally is the case. But, and this is a very important but, Chinese equities has now got very, very low correlations to US stocks now. Yeah, and that is a function of the way the US and China have been growing apart. You know, they've been growing apart geopolitically, they've been growing apart to some extent economically as well, and their stock markets have also diverged. So if you look at the Chinese sort of equities market, their correlation is some of the lowest in the world. So it tends to vary. At one extreme, the Singapore market has a very high correlation to the S&P 500. At the other extreme, the CSI 300, which is the Chinese stock index, or the Shanghai Comp, has a very low correlation to the US market.
Yeah. Yeah, I was going to say, like, the Hang Seng Index, which is the Hong Kong market, actually has a relatively high correlation to the S&P because you know, monetary policy is imported, the US dollar and Hong Kong dollar pegged. So, and because China has a closed capital account, because it has, you know, effectively, it controls the flow of money in and out of the market. You know, I think it does mean it's relatively maybe sheltered from monetary policy in the US. And so they get to pull all their own levers. Whereas in Hong Kong and Singapore, to an extent, you know, the monetary policy is imported from the US just because of the strength of the dollar. Yeah, that's all I have.
Absolutely. I think it's not just that the Chinese economy, the Chinese stock market is sheltered from the monetary policy of the US. The Chinese policymakers have very deliberately diverged from the monetary policies of the US. So over the last 12 months, while the US has been expanding its money supply like crazy, right? The Chinese have actually been causing some concerns by reining in its credit expansion. And that results in the stock market behaving in a very different way from the US, very different way.
Okay, interesting. Do we have any other questions from the floor this evening? Oh, okay, I think that's one more. Will it be safer playing ETFs in bullish sectors rather than try to pick stocks?
I think ETFs are, if you're starting out investing, like I've always said, ETFs are a good way to play the, you know, to get broad exposure. And, you know, obviously Seibu discussed that on the last presentation as well. In terms of bullish sectors, I assume you're talking like tech or like healthcare or growth. I think, you know, I don't think it's really sector specific, but if you are talking about, picking winners in maybe tech, it might be better to just do an ETF if you're not that concerned or bothered to go into, you know, investigating and doing your own due diligence on picking stocks. Then, you know, buying like a NASDAQ 100 ETF, like the QQQ, that's fine. I think that's good. And there are obviously healthcare ETFs that you can look into as well, that give you that broad exposure. So yeah, I mean, I'd say if you don't want to spend the time and the effort and all that going into the companies, then definitely an ETF is a great way to play those sectors.
Yeah, absolutely. I don't have any disagreement with Tim. I'm in furious agreement with Tim. Look, it's A and B. It's called alpha and beta, right? So if you're buying an ETF, you are buying the beta, which means it reflects the broad market, right? If you're picking a stock, you better get the alpha right, the A right, the alpha right. Now, if you pick the wrong stock, you're going to do miserably. So as Tim said, for beginners, if you don't know your alpha from your beta, go for an ETF.
Okay, pretty straight to the point. Any more from the floor? Oh, okay, there's still one more. US versus China versus Europe. Which market is more interesting for the second half of 2021? Any personal?
I guess I'll go first on that one. Look,
sorry, go on.
Go first?
Yeah, no, go for it.
Look, my what's the word for it? My ranking would be number 1 China, number 2 Europe, number 3 US. On the very simple logic that number 1 China is growing without the aggressive inflation that we're seeing in the US. It has inflation, but most of that inflation is contained at the producer price index. So in other words, it's at the producer level, it's not going through to the consumer level. And the Chinese have already done a bit of tightening, right? So which is why the Chinese stock market underperformed the US market in the first 4 months of this year. So it's already had its period of underperformance because it was doing a bit of credit tightening. So it's done that. and it doesn't have the aggressive sort of inflation. And I think the Chinese policymakers will start to relax a bit as the US starts to talk about a tightening. So again, you can see there are divergences between the two markets. So I like the Chinese stock market, number one. Two, Europe. Europe has started outperforming the US in the last couple of months. And I think that will likely continue because, again, for the same logical reason that the Europeans have much lower inflation rates compared to the US. And I think they are going to be, in that low for longer, they're going to be lower for even longer. All right.
Okay, cool. Tim?
Yeah, no, I agree with Sabrin on China. I think there's, they're coming out of the pandemic quite strong, and like consumer, confidence is quite high there. And actually life seems to be going on as normal in China. Like, it just seems like, they're vaccinating at a good pace as well. And, inflation's under control. So I think the inflation scare, everything sounds like really scary, but the inflation scare is only really specific to the US economy. It's actually not really being exported to China or Europe or Japan. So it's a specific US thing. And so, but I would say second for me is the US. I mean, it's run up a lot, obviously, but they're vaccinating fast, and, companies there, I think I'm probably more in the camp of, I think there's been that recent rotation back into growth. I don't know if that's going to continue, but for me, it's more like sticking with good companies and just with companies that will continue to perform. In the US, you have that. In China, you have that with, a lot of the tech companies as well, and a lot of EV companies starting to perform, battery companies. But I think Europe would be my last pick, just because Europe, I think, is just, they made a really real mess up of the whole vaccination thing. It was just an absolute nightmare. Growth is just anemic. It's been anemic for a decade. I don't see it changing. And, if we were being honest with ourselves, what big, great company has come out of Europe in the past decade? You see out of China, all these great tech companies, all these really innovative, EV companies, all these innovative, everything in, e-commerce and cloud and whatever in China. In the US, you see all these great companies coming out of the US in tech, and just humongous, massive, right? And then where's Europe? Where's Europe's Google? Where's Europe's Tencent? Where's Europe's Alibaba? There's no innovation in Europe to me. It's just really quite flat. I don't really see much. And I think there's a problem with, labor laws and labor markets there. And just, there's no, the euro is just a nightmare. There's no unification in terms of monetary and like fiscal policy, and there's no direction. And I think the corporate earnings picture has suffered because of that. And, banks have been weighed down by bad debt, and they've not cleared it out like they have in the US from the financial crisis. So for me, Europe is just, I personally just don't touch it, because I just don't see any opportunity there.
Okay, cool. We have another 3 more questions to go. So let's see what's it. Any sector stocks that are going to benefit from inflation or the US rate hikes? I think we briefly touched this a bit. So Sabun or Tim?
Yeah, look, I've already written quite a few reports about it, and our audience can request the reports, I guess, or you can go online and get one of our reports. My view, and I know it diverges from Tim, is that tech stocks will not do particularly well, and they haven't done well in the last few months, haven't done well year to date, in fact, are not likely to do well in an environment where people are expecting inflation and rates to go up. Yeah, that's because this goes to the very concept that Tim was talking about, that for tech stocks, or growth stocks for that matter, a greater part of their valuation is in more distant earnings, over the cloud, over the horizon, new concepts, new ideas, new products, new technologies that take time. And that means they have got a greater duration risk. Yeah, because as rates rise, the earnings that come 5 years down the line are more vulnerable to rising rates than the earnings that's coming 12 months down the line, right? So they've got greater duration risk. and the so-called terminal value tends to be a greater part of the valuation of tech stocks and growth stocks. And that is, again, subject to that duration risk. That's why I've said there'll be a rotation. And I've been saying this since fourth quarter of last year, rotation away from tech to old economy on the recovery. On that, and I've been recommending the oil majors, which I know Tim hates. I've been recommending the oil majors since second half of last year. And I am actually quite keen now on the next level down. And I'm mindful that there's a lot of activist sort of action, shareholder activism at Royal Dutch Shell and Exxon against global warming and all that. So I'm actually now thinking the next beneficiaries might be the oil services companies rather than the oil majors. So, get away from the heat, go on, because look, the oil majors have done fantastically well year to date. But whilst they're doing well, with all this heat coming on climate change and shareholder activism, maybe move to the oil services company. And there is actually an exchange traded fund for oil services, but I won't mention it because we're supposed to be talking generically here. But you can look that one up. So that would be one. And commodities are having a bit of a correction now. And I think I would be buying into the dip on commodities. Food, the agricultural commodities, the ETFs have done very well. And they're taking a dip now. And I'd be inclined to buy into this on that inflation theme. Gold is correcting. So I've been keen on gold from quite a number of months ago. And it's done very well again, but it's going to correct. It's going to continue correcting. But I'd be buying on a dip again on that inflation theme. So I'll stop.
Okay.
Yeah. No, I mean, I agree with Sabun on the rotation into value. Like it definitely, those like all majors, they're up like 50-60% year to date. So they've done very, very well. And obviously, tech last year was just a bit mental. And so I think that needed a breather. So it's natural with rising rates. But I would say 5-10 years out, because rates are rising, it doesn't necessarily mean that your returns over 10 years are going to be bad. They might not be great over the next year, which is, that's fine, right? But unless you're retiring in the next year, do you need to cash in? So I think it depends on your time horizon, right? So I think, maybe Sabun's talking a bit more on the short-term horizon.
Totally agree. Look, I totally get where you're coming from. Different time frames.
It depends on your time frame, I think,
to
invest. I think personally, financials, insurance companies, banks will benefit from rising rates. Obviously, bank shares will definitely benefit. The spread and like the net interest margin will be wider, will be better. They'll be able to make more from fees. Insurance companies will obviously benefit as well. So I think it's good to have a mix of different companies in your portfolio anyway, and not be too concentrated in just, either growth or too concentrated in value and income. So it depends on your time horizon. I mean, yeah, personally, I look 5-10 years out. I like a lot of, e-commerce names. I think will continue to do really well, regardless of what's happening in the global economy. E-commerce has taken off, and everyone in our generation, younger generations, even everybody, I think, is getting used to buying online. So they're just going to continue doing that, right? So you saw it in the US. I think it was it went from 4% of overall total retail sales in 2000 to sort of 12% in 2019, and then it shot up to 16% or 17% in 2020. So it's already close to 20%, but there's way more runway for e-commerce to keep taking market share from traditional retail.
Okay.
So
sorry,
yeah.
Tim, gotta stop you here. I think we have two more questions, and we'll have a look at them. There are more questions coming along, so we'll end with the last two. So if the FCF is dropping and it's not due to CAPEX, isn't it a red flag? Either one of you answer. You don't want to.
You're talking about free cash flow, yeah?
Yep.
Actually, yeah.
Okay, look, yes, that's a very simple answer. So I go back to my I wouldn't say rebuttal, but my rejoinder to Tim's comment about price to sales. I cannot eat the revenue. I cannot take the revenue away. What you take away as a company, as an investor, is essentially the earnings and more specifically the cash flow, the free cash flow. So even if it is due to CapEx, I do worry because, and again, I'm sorry, it's all gray hairs here. I remember the Asian financial crisis when a lot of Asian companies, right, were going broke when they were running net profits. Why? Because they were all expanding. They were all CAPEX, right? They were putting little pins on the board, on the map. You know, I've got an office here, I've got an expansion here. They were destroying value, right? So they were investing so much to give you that illusion of prosperity because their accounting profit was going up, right? But back to EVA, right? They were destroying value because their ROIC, the return on invested capital, was lower than the weighted average cost of capital. They were destroying the value and they had no free cash flow. In the end, when the debts came due, they went broke. So yes, when free cash flow is going down, it's always a concern. When free cash flow is going down, when there's no CapEx, it's a huge concern. Stop.
Okay, thanks, Vibin. Last question for the evening. There are so many questions that are coming up this evening tonight.
That's good.
Can we have this look at the last question? How should we position for the market right now? Should we skew our investments towards growth or value-oriented portfolio?
I'll pass this to Tim.
Okay.
I mean, as I said, like, yeah, it depends on your time horizon. If you are more value sort of oriented, I think that's probably, and you have a 12-month horizon or 12-month horizon, then that's fine. I think it probably will continue to do well. But then, as I said, like, just because rates are rising doesn't mean all growth stocks are going to be absolutely hammered. I think it depends on what businesses you're in, what sector you're in. Are you in a strong company? Are you invested in a strong sort of subsector of tech, or are you invested in something that's liable to get sold off like heavily, right? I mean, some of these tech names last year were just like 700-800%. So that's not normal. So I don't want people thinking that's normal, because that's extremely abnormal, right? If you look at long-term average returns annually, it's like 8%, all right? So that's a normal average annual return from a market. So anything that's up like 700-800% in a year, there's something very abnormal with that. And so that means a lot of growth has been baked into the share price for however many years. So for that company to continue to perform, it needs to exceed expectations on a consistent basis. And obviously that's not easy, right? After a year like last year, where a lot of these tech stocks their revenue exploded. So I think it depends on what type of names you're in, your time frame, but you should have a mix. I guess I would just leave it at that.
Okay, someone just gave one last question, and I think it's a good one to end off the night. So can we have a look at the last question? What's your view on banks, especially those in Asia? They profit from the rising interest rates and are considered as value, but seems quite vulnerable to fintechs. Opinions?
Yeah, look, generally banks, and Tim's already touched on this, in a rising rate environment, banks are generally favored, right? So the market, so it's not just about me or Tim, it's about what the market thinks. The market generally favors banks in a rising rate environment because your net interest margins go up, yeah? your NIMs, they call it NIMs, net interest margins, go up when you are repricing your loans, right? So you're repricing your loans outwards. The deposits get repriced slower, so you get a bigger net interest margin. So that's good for banks. So I would generally say yes, it's good. The next line beneficiaries would be insurance companies. So if you're looking at banks and they think, oh, look, they've all gone up. So I was looking today at the Japanese stock market. A lot of stocks went down, but Tokyo Mitsubishi kept going up. Again, this is that concept that NIMs are going up is good for banks. But if you think they're getting too expensive, then look at insurance companies, because insurance companies have very long dated liabilities, right? And inflation is good for eroding the value of long dated liabilities. And if rates go up, they earn more from their long dated assets, right? So it's also good for insurance. Generally, inflation is good for financial institutions.
Okay, thank you, Sebun. Anyway, thank you very much, everyone. We have come to the end of our presentation tonight. So there's a end of survey for the webinar. So just let us know your comments and to make it even better. So thank you very much and have a pleasant evening. Good night.
Thank you, everybody. Thank you, Ernest. Thank you, Tim. Bye.
Thanks, Abun. Bye, guys.
Thanks, Sebun. Thanks, Tim.
Ready.